Thank you so much for your patience. Good afternoon. This webinar offers closed captioning. To enable closed captioning, click on the live transcript button on the bottom of your screen and choose your preferred method. Welcome to the Chicago Department of Business Affairs and Consumer Protection. Please note, any website or email that I mentioned will be posted in the chat. For those seeking business license assistance, you can visit the Small Business Center here at City Hall or call 312-74-GO-BIZ. Also, business license can be applied for or renewed online at chicagobusinessdirect.org. If you are part of the BACP Entrepreneur Certificate Program, you can get credit for joining this webinar by sending an email to bacpoutreach@cityofchicago.org. To learn more about this program, please visit chicago.gov/business education. This webinar is being recorded and will be available at youtube.com/Chicago BACP. We'd like to encourage all attendees to ask questions. Please use the chat box to send your questions. There will be a Q&A session at the end of this presentation. Please note that the views, information, and opinions expressed during this webinar are solely those presented and does not necessarily represent the official policies or position of the Department of Business Affairs and Consumer Protection. At this time, I will now turn this webinar over to Mason Masad for us to begin. Sorry.
Okay, thank you everyone, and thank you for your patience. We're having some difficulties. I was sharing my screen. I couldn't advance my slide at the other end, so now Estella is doing it for me. And so this is a discussion on what a business owner needs to measure if he or she is running a business effectively. If you're in the audience, you have your businesses, some of the things I discussed, you may be already doing it. Maybe at the end of the webinar, you'll get something that you can take home and use it. If you're an attendee who is thinking about starting a business, then this will give you an introduction to some of the thought process a business owner has to go through. And keeping that in mind, let's go to the first slide. So the discussion is divided into 6 segments. I'm going to introduce you to something we call business cycle. The reason you need to know about business cycles is maybe you are a business owner that have 2 or 3 products that are out in the market. Maybe you're rendering different services like tax accounting, maybe snow removal, whatever your offerings are in terms of service. So each of your business segments may not be in the same cycle. As a business owner, that indicates that you have to think about them in different stages. Then I'm going to walk you through the business organization. Even if you're a business owner that has you as the only employee, or maybe you have 5 employees, maybe you have 3 employees, it is still an organization looking to do something. So I'm going to introduce you to the organization concept. Once I do that, we'll talk about people, your employees, because you have to hire them, train them, retain them. So they are really the pulse of your organization that does the conversion from what you're trying to do into actual product or service. The 4th segment we're going to talk about is process mapping. This is what I find is many small businesses are not familiar with the importance of process maps. So when you do the activity in your organization, there are many processes that happens. So you have to make sure that the mapping of those processes are done, primarily for several reasons. One is when you bring in a new employee, you can use the maps to train them. When a finance person in your organization or yourself are thinking of costing your processes, you will need a process map. So the process maps are very useful, and I will show you some examples. Then we walk right into business financials. Business financials are numbers you look at to decide if your business requires some improvement to operate optimally. Then the last segment will be in operations. Operations is the part of your business that transforms your input into output, be it a product or a service. If you watch these 6 segments on an ongoing basis and your business is healthy, then you can start thinking strategically and I will introduce 2 or 3 concepts, what strategic thinking means. So now we go to the next slide. Now, this slide, I'm not gonna go deep into any of these discussions. I am just trying to indicate to you that if you're a business owner, you already have thought through what kind of business structure you should have and where your funding should come from if you need some funding. The reason I mention this is if you are a person in thinking of launching a new business, there are discussions on SCORE website. There are webinars also given on these kind of topics. So you may be able to attend those and become familiar with what kind of business structure you need to have and how do you do your business plan and get some business funding. Next slide, please. So as I indicated at the beginning that we are going to talk about business cycle right off the back. A business cycle is nothing but differentiating the different stages your business may be in. So if you follow this curve here, so business has a starting point, it has a break-even point, it has a growth stage, and the leveling off. The importance of this curve is to know that when you start your business, if I plot the revenue on the vertical axis and give you some time on the horizontal axis, the business may be in the beginning in a turbulent phase, which is like a phase where you're not really recording positive cash flow. And it takes a little while for your business to have enough customers, enough output, enough manufacturing capacity till it hits the break-even point. Once you hit the break-even point, then your business is going smoothly, the revenues are increasing, you're covering all your costs, then it levels off. This is why I say that if you sell 2, 3 different kinds of products or render 2 or 3 different kinds of services, you have to think of each of those products or service in terms of this business cycle, because that would mean what kind of emphasis you have to put into the business, that business segment. The other point I'm going to make is if you look at this curve where it flattens off, it means that your cash flow has kind of stabilized and it's not growing, which means that you have to reinvent that segment of the business, which is called strategic thinking. So that's keep this picture in mind as we go through the different segments and how to manage your business. Next slide, please. So this is a harsh statistics that every small business owner has to be aware of. Small Business Administration publishes these statistics on a regular basis, but the general trend is 50% of the businesses fail in the first 5 years. And hence the emphasis of this workshop. Why do you have measure your different parameters on the business? Otherwise, you wouldn't know where you stand and it could be on shaky grounds and it can fail. Now, when I say measurements, I'm gonna right off the bat differentiate that there are 2 kinds of measurements. There are qualitative measurements and there are quantitative measurements. The quantitative measurements are very clear when you look at a balance sheet, when you look at income statements, you're looking at numbers. Those are quantitative, but qualitative measurements could be you use some spreadsheets, you use some documentation of some sort to keep an eye on different segments of the business. And I will, when I discuss each of these segments that I laid out, the 6th segment, I will show you what kind of qualitative measurements you could use to assure yourself that you're healthy in that segment of the business. So I've emphasized the importance of measurements, and now let's walk into the next slide and talk about organization structure. So as I indicated, that whether you're a one-man show, one-person show, 5-person show, your business is really an organization. It has these 4 segments that this is a broad brush definition of the organization entities. So first, your organization may be virtual or is operating in a physical space, or it could be a mixture of both. Your organization have people with different roles and responsibility, and then you do generate a product or some kind of service. And this is the important part. This says that you supply to a certain market demand. By that, I mean that when you start your business, I assume you did all your market research and determine what amount of dollar market exists. Let's say it's $50,000 market in the product that you're selling or service you're rendering. And maybe you can, because of where you are, take up 10,000 of that $50,000 market demand. So you have a unique value for your product or your service that says you will get enough customers to get 20% of that market. So always think in terms of this, that your organization is meeting some portion of the market, but not all. So that puts you in a frame of mind that how can you grow the market to the entire segment if you are able to do that. So organization itself is thinking about all these 4 segments that I pointed out. Let's go to the next slide. So I'm going to arbitrarily give you a very simple definition of an organization structure. I call it simple because this organization chart doesn't have all the roles that could be in your organization. So you have a business owner, you have some finance individual or third-party finance that helps you understand what are your finances of the organization, meaning your balance sheet, income statement, things like that. Then I will divide the organization structure into 2 sides. There's the operation side, and then there's the sales and marketing side and new business development side. So I call this side as the revenue generator. So this is a side that you want to keep supplied or supported all the time. And this is the operation side where you're generating your unit of sale. So my point in this, showing the organization structure in this way, is this operation side always have to be most optimal cost, meaning the low cost segment of your business structure. And this side, which you need to support 100%, needs to be supplied with whatever you're selling so that they can make their sale, because unless you make your sale, you're not earning any cash. The many small organizations may not have all this kind of a structure. Maybe the same person, the business owner, is playing all these roles. The point of caution is if you play all these roles, you're switching from being an owner to an operation type of role to a sales and marketing type of role, which requires different type of thinking, and it may conflict with each other. So if you're a sole business owner, always be cautious, understand what role you're trying to play, and optimize that role. Another point I make here is in a small business, this may evolve gradually till you feel the need for that kind of a role. So which is fine, but eventually you'll have an organization structure like this. Next slide. So this is still not a KPI. I will emphasize that in an organization structure, which has all those 4 components, you have to have the right reporting relationship. You have to have capable individuals. You have to have job descriptions for all your roles. And then I'm going to emphasize these 2 points, which is very common in small businesses. You may have friends and family in the organization that help you out, which is not a bad thing, but you have to be able to separate the personal and professional relationships between each other. And then as an owner, as you grow, which all business owner wants to do, you have to be spot on when to hire and delegate. Because if you're stretching yourselves to perform many different roles, you may be throttling yourself and not getting or achieving the right amount of growth or or the right amount of functionality to have the growth that you need or you want. Next slide, please. So this is a KPI for organization. So I've defined the organization for you. This is simply a spreadsheet. You need to maintain who is in your organization, who is reporting to who. You must have job description for all of those. These jobs must be filled. And then this is very important. Do you think that the person in the job is a good fit or not? If the person is not a good fit, like these no's over here, doesn't mean that you have to get rid of the individual. It's just that they're in the wrong job and you have to assess, because you've invested in the person. So you have to assess how to shift their responsibilities so that they can be a good fit. And then this is another key thing is, do you have succession planning for all your people in the organization, at least the key people, because the key people make your organization tick. And if they are for some reason not on the job, be it their vacation time, be it they leave the job and go to another company, then do you have a successor for that job? And key roles must have successors all the time. Next slide, please. So now I indicated to you that organization has people in it. So now I'm going to shift to the people segment of your organization. The people it's a huge amount of investment for you to hire people, to train them, to engage them, to promote them, which is important because nobody wants to be in the same job all their lives. So you have to have promotional path for the employee. And then you have to retain them because a competitor of yours may prefer to have a trained employee from your company and take that person away from you. So the outcome with people is this side, where you want capable, trainable employees. You want their retention to be very high because every employee you have in the organization, whether you notice it or not, you have invested time and money in them. So you don't want to lose them. On the other side of the table, the employee must feel satisfied. So satisfaction indicator in their minds should be high. These two are also important. The skill mix and cross-training should be wide. Why is that? Because remember, we talked about succession. So a backup person, if their skill mix and cross-training are wide, they can back up each other in their roles, and that's an asset to you. Then I'm going to say that employees should also be appreciated, rewarded, and we're going to talk a little bit about that in later slides. Compensation must be competitive, otherwise you won't be able to retain them. And the final point here is you must have diversity in your employee base. I don't mean not only diversity in demographics and gender, but I also mean diversity in thoughts and ideas, because if you only have a yes person in your organization, you're not going to see a different kind of thought that could be applied in that process, or that could be applied in achieving what you're trying to achieve. So diversity of thoughts should be encouraged by you as a business owner. Next slide, please. So here is a slide because I have indicated that people you should hire very carefully and retain them. So I lay out 4 different segments here: how to hire them, how to train them, how to develop them, and how to give them reward and recognition. Some of these are self-explanatory, but some of these I want to emphasize. So when you're hiring people, obviously you want to hire them for their education experience, certification, so on and so forth. But this is very important. If you start doing this in your organization early on, when you hire people, whether they have the growth potential. By that, what I mean is they should be able to be trained and developed and move on to a higher job. And that will have satisfaction on their side, knowing that they have a bigger future with the company. And then there's the exchange that you have retainment of the employee. So the growth potential is very key. You should have process and procedures to train these employees. When we talk about process maps, you'll see the importance of that. So you can you can make them learn through written process and procedures. You can train them or give them experience. They can shadow an experienced colleague or an employee in the organization. Repetition will give them good training. And this is very key, allow for learning curve. Each one of us has different ways we learn, and the learning curve is a variable thing. So if you value an employee, you or your manager should give them time to learn on the job. As long as you feel like that person is doing their best and they're going to move on to a higher job in the future, they'll be good for the company, give them the time to learn the job and then start producing. Development of the employee comes from, I think we touched on these before, increasing the responsibility gradually, sending them to trade shows and certification, if that makes sense, and then cross-functional training. We talked about that before. And this last segment here is assessment. Assessment is a feedback to the employee. You're creating a contract with the employee when you hire them. So here, the way to look at it is every job should have goals and the employee fills the job. So the goals and expectations should be clearly identified. But once that is done, there should be a way of doing these two things, which is self-appraisal and performance review. So allow the employee to give you feedback, you or your manager from time to time, how he or she thinks they're doing on the job. If you give them the feeling that you value their opinion, you can correct your course of action if they need a little more training, or if they need maybe shadowing another employee to learn a little bit extra. So that's where the self-appraisal is important. And then performance reviews should be given at a regular interval. Most people, I think, do it once a year. If you hire and train people correctly, the delta or the gap between self-appraisal and performance review will be very, very minimal, meaning there will be very few dispute points between you and your employee. And the final point is giving them reward and recognition. I'm going to mention something here that if you must have a personal understanding of each of your employees. So by that, what I mean is, if you know that an employee enjoys going to the ball game, so the reward can be small, giving them tickets to the ball game. Or if an employee likes to take his wife to dinner once in a while, give them restaurant vouchers or something like that. So determine what award would be and what reward would be meaningful and give them that reward. It doesn't have to be a huge sum of money. And when you do that, the employee feels like, okay, I'm being recognized, and the reward that my boss gave me is something that I like to do. So you see, you're achieving some softer relationship there at the same time. One other thing I want to mention is when you set goals and expectations for each jobs, remember that goals have to be, you may have heard the acronym SMART. So the goals have to be SMART. They have to be specific, they have to be measurable, they have to be achievable and relevant to their job, and then time bound. So the employee will know within 1 year's time, this is what is expected of me, and that's what they focus on. So defining the goals and expectation very carefully actually helps making your organization optimal. Next slide, please. The next couple of slides, I'm going to talk through, now that you've hired and trained your employee, how to keep an eye on your employee performance or engagement. So what I did here is create 4 boxes. It's against the axis of engagement and skill sets. So if you did your hiring and training right, most of your employees will be in this box, meaning they're highly skilled and they're highly engaged. But few of them may be in this box and this box, meaning some of them are highly engaged, but needs skill-wise, they're not as up to par as they should need to be. Then the question of training, you need to focus on their training. And this box says highly skilled but not engaged, which is a motivational thing. And you need to work on that. So these three boxes are okay. Most of your employees should fall in these boxes. But if any falls in this box, meaning that they are not skilled, they are not engaged, that means that you didn't do your hiring part right. So that is the emphasis of this chart or this depiction of four boxes. I'm going to add to this an example. In General Electric, which was a big corporation and still is, there was a CEO by the name of Jack Welch, and he used to use this method and used to eliminate managers and employees that fell in this box. But I just thought I'd mention that, not to say that be like Jack Welch, but that is how you assess if your good employee base is all engaged and skilled for the job. The next slide that we're going to now is, next slide, please. So this is another famous person, President Eisenhower, the 34th president. He used this technique to kind of weed out things that the employees need not focus on. So what he used to do is create a task list. So in addition to your regular day-to-day job for your employees, the managers or the employees may create a task list that they need to do in addition to their job. So if you take that list and every week or every other week with your employees or with your managers, rate the tasks into these four quadrants. Are they important and urgent? Then you should say, do it. Are they important, not urgent? Then just schedule it. If they are urgent and not important, delegate it. But if they fall in this box, not important, not urgent, eliminate it. You would be amazed by doing this simple exercise that there are many to-do list items that simply fall off if you do it on a regular basis, like every week, so that the employees do not spend time on things they do not need to spend time on. So now that I have indicated to you how to hire, train, retain, and make the employees engaged and skilled, now I'm going to share a couple of slides, one slide with you that says, how do employees work together? So let's go to the next slide. So this is a famous procedure used by many operating people who are managing businesses. It's called the RACI analysis. So when you have a lot of things to do for your employees, including your managers, you could take each item on your list and say who is responsible, who is accountable, who is consulted, and who is informed. So by doing that, and this is the simple spreadsheet that I'm showing you, that you put the names of your employees and managers and say who is working on each of your activity that you want to focus on. And you should have, against each item, these RACI identified in different blocks. That way you can assure yourself that your people are engaged and they're working together and they're keeping people who needs to stay informed. You will feel the need for this even more when your organization grows as your business finds success. So far on the people side, I've showed you some of the skill set you need or processes you need to get a good employee base and how you keep an eye on them. The next slide is a KPI again. This is again, a qualitative KPI, but is very powerful. Either you or your HR manager should do this on a regular basis. So you keep tab on all your employees and you make sure you're aware of their hire date, their number of years on the job, what kind of performance review they're getting, performance ratings, training, workshop, if they have needed to go to, have they been to those, promotability. Again, I cannot emphasize more about this, that growth in the employee means they will become promotable at some point, and then keep a tab on current compensation and next increment date. If you keep an eye on this, you'll keep your employees happy. And so here's a KPI that that you need to keep an eye on. Now we covered people, organization, and the people. Then the next thing I'm going to go into, remember I said a lot of small businesses do not worry about process maps. So let's start our discussion on process maps. So let's go to the next slide. So here is a segment on process map, and I right off the back say process maps are needed for your product or service to be consistent. What does that mean? That means that you're providing consistent good product to someone or consistent service to someone, which means your customers are happy. And if you get good customer reviews, that strengthens your brand or strengthens your sale, right? The opposite of it would be bad, meaning that your customers are writing negative reviews that will destroy your brand or destroy your sales, so which is not something that you don't want. And then I also put in here process maps also creates a scenario of being efficient. By being efficient, what do I mean? I mean that you're doing a process with the few number of people that you need and the quickest amount of time, that thereby the costing of the process, the cost of that process is low. And we're going to discuss this a little more as we go into deeper into financial KPIs. So next slide. Thank you. Here I point out that what is a process map and why is it necessary? So I'm reiterating what I already said in the slide before. So a process map is basically a sequence of events. It could be a simple chart to go from your start point to your finish point. And which you will realize that many of these processes link up together to provide the total process. So a total process in your operation may be composed of 10 different processes, and they have to come together, and that requires additional kind of scrutiny from you, the business owner. The second point I make is about avoid mistakes, which is undocumented processes. People are then just not following a process and they're making mistakes, which you don't want, and they could be costly. Process maps can be used to train employees. We talked about that. And these last 2 points, I will emphasize again that process maps will be needed to do determine the cost of your unit or cost of your sales. There are 2 different terms used for the same concept. COGS is cost of goods, and then cost of sales is COS. These are terms interchangeably used to only mean that whatever you're selling, be it a product or be it rendering a service like a cleaning service or plowing service or landscaping service, how do you cost that out for your own understanding that what is it costing you to do that? So without process maps, you cannot do that. And then I mentioned a little bit about processes being balanced. So intuitively, you know that if you have a process that is slow matching up with a process that is fast, the slow process will not be able to keep up with a fast process. And then that may create a little bit of inefficiency when it comes to the time. So let's say you have 8-hour shift, maybe your some of the processes are staying idle for out of 8 hours, 5 hours. You don't want that. So we'll talk about that also in later slides. Next slide, please. So what I've done here is, as you saw in my write-up or introduction, I do work with SCORE Chicago and North Lake County. And as a result, we do work with businesses that are in operation when we try to mentor them and so on and so forth. So if you don't have SCORE Mentor, please consider looking up having one so that they can give you some good advice. But here are 2 process maps I have given here, and I've simplified it terribly. So in the real business, if the business owner was in this audience, he or she will say, hey, you didn't include this or that. But I have included them here just to make a couple of points. The one on the left is a product type process. The one on the right is a process, service type process. So the left, one on the left is actually making printed t-shirts, and we are all familiar with them when we go to Bears game or when we go to a show, we want to buy t-shirts. This is a service type, which is called office build-out process, where we are very familiar. We are all familiar with, storefronts or offices or office space we rent, and then we want to fit it out. Like we want to make cubicles, we want to provide furniture, we want to provide electrical outlets, things like that. So this is that kind of a service. So when I look at the process on the left, the input part of the process is the stop part. So what is it receiving? It is receiving some ink, which needs some preparation, which has a lot to do with the viscosity of the ink, which has a lot to do with what color it will be, things like that. Then it has some artwork preparation, which is an interface with your customer actually, or his customer, this business customer, that what kind of logo or what kind of artwork goes on the t-shirt. So there is a lot of back and forth between the customer and the business owner here. And then you have to prepare a printing plate with the ink and the artwork. So you can easily imagine that this is a slow part of the process. It takes time. Then it goes into a section of the process where there's screen printing of t-shirts coming in and ink drying. So this is a little bit automated. The business owner has machines. He may have 3 machines. The question could be, does he need 5 machines? And then the packaging part of the process is very, very quick. The shirt gets tagged, folded, packaged, shipping. So you have a slow process matching up with a reasonably quick process, and then a very fast process. So looking at this process map as a business owner, you know that you have the speeds of different operations do not match. So do you want them to match? Do you need them to be matched? And how do you make them match? So in some cases, you buy more equipment. In some cases, you hire more people, you run more shifts. So that's why I say that process maps will tell you whether your processes are balanced. If not, you have to ask the question, do I need to balance them? And when I say you have to ask the question that relates to your capacity, which we'll talk about later in the operations side. Now, on this side, which is a service type business, the customer orders are coming in through email, phone calls, through their web page. So this is a very fast process. But then what happened? The business owner says, I'm going to go look at the job. I'm going to estimate the job and order some materials if I'm picked, and schedule and dispatch my crew to do the job and inspect. If the owner accepts it, there's invoicing. So this part of the process is really slow. He's kind of takes the job request. He goes out to the field. He or she then provides a quotation of some sort, which requires estimation for the job. The customer has to agree. So this is the slow part. And then this is the fast part. He dispatches his crew. It gets done in a couple of days or a week, and then he invoices them. So again, there is a fast process matching up with slow process and going to a fast process. So as a business owner, depending on where your capacity is, you may want to speed up some process or not. When I say capacity, I always mean, and I want to drill it into your thinking, that capacity is people capacity as well as equipment capacity that you may use to deliver your unit of sale. Now, these kind of process maps can exist even in other parts of your business, like planning and conversion. There is shipping and supply chain, or for that matter, any other segment of your operation that you have. So there are many, many process maps that should exist in your documentation. Next slide, please. Okay, so now I've described to you process maps, I've described to you your organization, I've described to you your people. Now we're going to go into business financials. Here comes the quantitative side of your business that you're going to keep an eye on. So as a business owner, nobody would argue with me in this audience that their main interest is to generate profit and increase their equity. So generating profit means that the price you're charging to sell your unit of sale brings in revenue that not only covers all your expenses, but leaves some money in the bank. So, and you want to grow that margin. And when we look at an P&L, we will go a little bit deeper into that. Increasing equity, I would say that if you took a loan to start your business, you have liabilities, you have bank loans. So bank loans is a liability to you, and that shows up in your balance sheet. When we look at a balance sheet, when you're generating good profit, as a business owner, you may say, oh, I want to reduce my liabilities and thereby increase my equity. And we'll see that as we go into the balance sheet discussion. There is an emphasis I put in here, hold less inventories. Now, for a product type business, inventory is an actual product. For a service type business, it's your inventory of people, right? If you're providing tax service, tax accounting service. So if you have 10 tax accountants and you're only using 7, you have people in your inventory, but you need to convert the inventory, what I call sales. So in a service type like tax accounting, you want to engage the other 3 that are sitting idle on the bench. In case of products, your product on your balance sheet is at the cost of goods, and I'm jumping a little bit ahead of time, ahead of my slides, but inventory needs to be converted to sales as quickly as possible. So hold less inventory. Some of the terms I'm going to introduce you to are listed here: cost of goods, P&L, which is profit and loss, and income statement. They're basically the same thing. Balance sheet. I'll introduce you to working capital when I go to the operation side of your business, when we discuss the operation side, but I wanted to introduce that concept in the beginning. So let's go to now we're going to start focusing on P&L, income statement, via discussing revenues and cost of goods. So let's go to the next slide. So here is a slide on pricing and revenue, and some of it we'll discuss here and some of it we won't. But the concept here is revenue is a line item on your P&L and income statement, and you'll see that when I show an example that I pulled right out of the internet. So what is revenue? Here's the revenue, which comes from pricing and number of units sold or number of services rendered. Now, you can attend a webinar on pricing from SCORE or other agencies. But I'm not going to go deep into that. But you as a business owner sets your price, right, for what you're selling. And that setting of price have many, many different strategies, as I listed here. I just wanted you to know that there are different ways you can set prices, like cost plus price, and some of it are obvious: demand-based pricing, marginal cost pricing, return on investment pricing, experience curve pricing, competition-based pricing. So they're all good methods. It's just that you have to decide which one will work for you, because when you set your price, your customer has to come to you, right, for that price. So it is it's a very important area and needs a deeper understanding. And I defer that to other webinars that SCORE puts up. So for now, all you have to keep in mind is revenue is a line item, and it is just a product or multiplication of price and units sold. We go to the next slide. So now we're going to go into cost of goods and cost of sales. Now, this is, again, a line item on your P&L. That's why I'm walking you through these things. Now, cost of goods is what you're trying to do is based on your organization. You are trying to determine what is it costing you, the business owner, to sell the unit of sale, whatever you're selling, whatever product you're selling, whatever service you're giving to people. So that's simply the definition. In other words, it's cost to produce or cost to provide the service. Now, there are two ways of determining cost of goods. One is a lengthy way, lengthy, laborious way, and the other is an easy way. So I call them the top-down method and the bottom-up method. The top-down method is the easy way. So an example would be if you, this month of November, if you have spent $10,000 in your business to produce 100 items, 100 items that you sell. So the cost divided by the number of unit, or the number of unit divided by the cost, whichever way you look at it, gives you what it costs you to produce one unit of item that you're selling. So that's the top down. Now it's an easy method, but it has a lot of downsides. The downsides for the business owner is if you take the easy way, you don't really know what are the elements of that cost. You don't know which element to manage, because remember I said the operation side has to be cost effective, cost optimal. So you want to reduce the cost. Why do you want to reduce the cost? When I show you the P&L, you will see that if your cost of goods is lower, your profit goes higher. And I'm sure most of you know that. Now I'll get into the bottom-up pricing, which is the laborious method, but once you do it, once you have a procedure to do it, you will like it, because as a business owner, you will know all the details. So the laborious method makes you focus on three things. In your organization, there is a material you buy, there is labor that uses the material to produce what you're selling, and there are overheads. I'll show you what overheads mean. These are mostly utilities, maintenance, things like that. And so the discussion here is, I'm going to walk you through material cost, labor cost, and overhead cost. And I'm going to try to share with you how to reduce the cost whenever I can. So on the material side, we all know intuitively that if you buy 10 units of something from a supplier versus the 100 units, if I buy 100 units, he may give me a cheaper price. So that is called volume-based tier pricing. Means that you buy more at one time and he gives you a better price. Then there is consortium price, which is more like, another business which is similar to yours and they buy similar items. You can go and network with that business and say, hey, you buy this thing from this supplier, I buy this thing from the same supplier. How can we kind of send our orders together and increase the volume again and get lower costs from him? So that's consortium purchase. This item that I show, exchange rates and tariffs, this applies if you buy your material that are imported. So exchange rates. Right now, you may be aware that a dollar is very strong against euro, against British pounds, so on and so forth. So if you buy material from those countries, with your dollar, you can buy a lot more. So you may tell yourself, oh boy, I'll go ahead and buy 1 year's worth of material and thereby get more for your dollar. That's exchange rates. Tariffs are, this is a thing we have heard a lot about recently in terms of trade agreements with different countries. So if you're buying internationally, tariffs may affect you favorably or adversely. So that's the discussion on material cost. I'm going to show you how it is added to your overall cost of goods. Now let's go to the labor element of your cost. Next slide. So the labor element, to price out your labor, is very intuitive again. What it is if you have a process, remember all the process maps that we discussed, and if you have them, your manager managing that process or you managing that process can easily determine how many people are in that process and how much time do they spend. That's called labor hour. So every process should have a labor hour estimate on it. And then you know how much you're paying your people. When I say paying, I don't mean just salary, all the fringe benefits, healthcare benefits. So you will have a unit for cost of labor hour. So if you multiply the two, how much labor hours you have and the cost or the cost of your labor, that gives you the cost of the labor rate cost. Now, I should also point out that you have direct labor and indirect labor, meaning direct meaning people who are directly involved with that process, but there are indirect people who are working on it indirectly, like the planning people, customer service people, quality people. You yourself as a manager maybe is not accounted for. You're not doing the process yourself, but your people are. So you are indirect labor to this process. So that's how you calculate your labor cost. So we talked about material cost, labor cost. Let's go to the next slide, which is an indication of overhead cost. And overhead means these kind of items that you are paying for, but it's not directly related to the process. So your building space, equipment depreciations, your utility cost, all the electricity, water you may need, maintenance costs, taxes you pay, insurance. So the finance people call these overhead. And variable overhead is if the overhead number changes as you grow your volume of production or as you increase your capacity. So that's variable overhead. So these three elements, material, labor, and overhead, go into determining cost of goods. So let's go to next slide. So before I show you the P&L, this is a little refresher. Revenue is based on unit price and units sold, product of the two. Expenses, we talked about cost to produce. We just touched this item, but then there is cost to deliver, cost to market, maybe any development cost if you have any. If you're that t-shirt printer, maybe you're trying to develop a cheaper ink or something. So those are development costs. Each of these categories will also have a process, will also have those material, labor, overhead component. So in the expense item, when I show you the sheet, it will have those costs in it, just not cost of goods, but cost to deliver, supply chain costs, sales and marketing costs, things like that. So remember I said as a business owner, you love to make profit. Profit is just the difference of revenue and your expenses. And when I show you the P&L, you'll see the taxes and interest payment come in too. So let's go right into an example of P&L on the next slide. So this is a P&L. I'm sorry for the small numbers in it, but I wanted to pick out all the categories. This is just a company. I don't know what type of company it is. And right off the back, you see that this is a P&L that the company had. And the numbers are in millions, and they are a 12-month spreadsheet. So it's for the full fiscal year, which means the fiscal year for this company goes from January through December. And for each of these months, what they have shown, either the business owner or the finance person working on this, is there are two revenue streams. There's revenue one, revenue two. Maybe he has two different kinds of products he sells. Maybe he has a one product and one service that he sells. So it could be a combination of many things. So your P&L will have different revenue stream like that. Now I'm going to bring back something I discussed with you a little bit earlier. Remember the business cycle? So the revenue stream, depending on where the product is, meaning is it in the upward trend, if it is on the stable end, if it is still trying to break even, the revenue stream as a business owner, you should understand that they're in different parts of the business cycle, and the revenue stream may look different. And you may have the hunch of how to grow that revenue, depending on where in the business cycle it is. This is a P&L I'm pulled out of the internet. This is a line item for refunds, returns, discounts. Those come in when you're in a big operation. The one I would like to bring your attention to is this return line, because if people are returning your product that you're selling, it's not a good thing, meaning you have defects in the product, which means that your quality, your processes are not good, your employees are not being trained properly. So that will be, that you need to keep an eye on that. We talked about cost of goods. Here is the line for cost of goods. In this P&L, they didn't break it up for the two streams. Maybe the business owner wanted to see it in a one lump sum. So the difference of your revenue and cost of goods is your gross profit. These are terminologies that finance people like to use. Now I'm going to bring you down to this line, expenses. So I'm not indicating to you that these are your expense lines. You have to determine what are your expense line. But I'm going to use this example to highlight a few things. So here is the advertising and promotion, which is your marketing expense. So if you look at that line, if you have a product that's stable, maybe you don't need to spend as much money on marketing. If it is a product that's growing, you may need to spend more money on that product. If you have a product that's just launched, maybe you need more promotional money. So as a business owner, you may ask your finance person, what's the breakdown for these numbers for all the revenue streams I have? So you can determine whether you need to pump more gas on that or pump less gas on that. Another line I'm going to discuss is salaries. So you may ask me that when we determine the cost of goods, we took the labor element. Why do I have a payroll here? There is a salary, benefit, wages. The reason they keep a line like that is not everybody is part of the cost of goods line. So if there are people somewhere in the organization that you don't, that is not accounted for cost in the cost of goods line, they go in this line. So they're not double counted. That is my point here. So these are your expenses. And remember, if I focus on one column, they're subtracting from your revenue. So they are taking money away from you. So you need to always, as a business owner, determine how to minimize this part. And then if you look at this line, earnings before interest and taxes, what this means that this is your profit, if you may call it, before you pay interest and tax. Now, I'm going to emphasize with you now that it's a good thing for a business owner to reduce taxes as well as interest. And how do you do that? If you reduce your liabilities that we're going to talk about in our balance sheet, it reduces your interest. Taxes, there are many, you may have heard that there are many tax-free zones in this world, like Singapore or less tax regions in this world. Puerto Rico is to be one, Singapore is one, Ireland is one, Netherlands is one. So if you're such a business that you can move around the world and seek out less tax zones, then you can reduce your taxes. So earning before taxes, and then you go to the net earning. So that's a P&L, and you can look at just one slide and get so much about your business. Then now we're going to talk about balance sheet. So the next slide, please. So a balance sheet, unlike the P&L, a balance sheet is date specific. So if I wanted to see your balance sheet, it has to be today, November 9th. What is your asset? What is your liability? And what is your equity? So by nature of the definition, asset, you always want to increase your asset, right? Liabilities, you want to reduce your liabilities. If you do that, your equity is going to grow. Why do you want to grow your equity? Because right now, because of your liabilities, which partly is your debt to the bank, a bank owns most of your business, so you want to reduce that and get the business under your ownership, financial ownership, as quickly as you can. In the asset side, this segment here, you will, when I show you the balance sheet, you will see, or a typical balance sheet has cash assets, fixed assets minus depreciation, inventory, and receivables. So here I'm introducing you to a new term, receivables. It is nothing other than receivables are money you get from your customers. You're receiving the money. So that's as simple as that, receivables. And inventory, when it shows up in the asset column, we discuss the cost of goods, right? The inventory is listed at cost of goods at the price it's costing you to make the inventory, but you want to convert that to sales because you're selling at your price. Your price is higher than it's costing you. So immediately the asset grows because your cash asset increases and inventory reduces. So as a business owner, you don't want to hold too much inventory. On the liability side, you will see terms like payables and debts. So payables is similar to receivable. Payables are money you're giving out of your pocket to your suppliers. So when we discuss operation, I'm going to talk to you a little bit about how do you negotiate contracts with your supplier and customer. And then debts, these are debts you have. And then now simple subtraction of those two items gives the owner equity. So now we're going to go and look at a balance sheet on the next slide. Unfortunately, it is a company, Amazon, so it is it is not typical of a small business. But I want to point out a couple of things here. On your cash current asset, you see your total asset line is right here. First thing I want to point out is, I don't know if I can move this out of the way. First thing I want to point out is it's date specific. So December 31, and the years are 2016, 2017. So they're giving a balance sheet comparison year over year at the end of the year, 2016 to 17. So if you look at total asset, the total asset has grown, which is a good thing. Then the liabilities are these items on your balance sheet. And when I studied this, I see that these three liabilities, long-term debt, other debts, they are actually going up year over year. So, which is not a good thing, but maybe he had to take on more, the company had to take on more liabilities to grow the asset part. So unless I know the business logistics, it's hard to comment on that. But if you drop down to the equity line, which is subtraction of the top, subtraction of the middle from the top, you see the equity is growing, which is a good thing. So when we get to the Q&A, I'll see if you have any more questions. But those are the financial sections of that KPIs that I wanted to discuss in this webinar. Now we're going to go to the last segment called the operations segment. On to the next slide. See, the operations segment, I wanted to break it out into three types of discussion. There is discussion one, make or buy, and then the supplier-customer relationship with you and the contracts you make with them and the terms of payments with them. Then I'm going to go into demand forecasting and production scheduling, because once you have agreed that you want to supply something to your customer, you have to make them or plan for them in case you're a service business. And then we're going to talk a little bit about capacity. Again, a reminder that when I talk capacity, it's both people and equipment. So this make or buy box. In a business, when you go into a business, you don't have to make everything you sell. This is why make or buy analysis is important. So if it is a product that you're selling or a service you're providing, that you can be a middle person, like if you want to be that, and you negotiate with some companies that you are going to create sales for them and at a certain markup, and you just do buy and sell. So that's a buy concept. But if you want to make the product or render the service, all these discussions I've had so far applies to you. Now I'm going to go to the customer and supplier segment. To do that, I'll jump into the next slide. So I've broken it out by supplier and customer. And I'm going to break it out even more. These top two is the contractual part of the discussion. These remain, other two or three is a performance type of supplier customer evaluation. And the last one is relationship building with your supplier or customer. So what I mean by that is, uh, let's pick one supplier side. You want to make a contract with them to lock a good price. What is a good price with a supplier? Because you are paying them, you want the lowest price. And we already talked about how to get the lowest price when you're buying material, right? So on the supplier side, customer side, you want to lock in a good price for a desirable period. Now, this is where your pricing comes in, right? So you're selling it to this customer. You want the highest price possible, right? So there is this different, just a other side of the coin with the customer. In terms of payment terms, I say that with a supplier, you want a delayed payment terms. It's almost like saying you don't want to give the supplier money quickly. So maybe it will be after 90 days or something. So you have to negotiate those in the contract. And on the customer side, you want an aggressive payment, meaning that you want to grow your revenue lines. So you want that payment to come in maybe within 30 days. So that's the contractual side. And a business owner, if you have feel for your customer and suppliers, you will know with time how to negotiate these contracts. The performance side is the quality history of your customers and suppliers, whether they respond to you when you are in a bind, things like that. For a supplier, lately there have been a lot of supply chain shortages or delays. Response history becomes very, very important. And then the relationship side means that you need to visit either virtually or in person your suppliers and customers to keep those relationships going. So now I'm going to go into slides that we will discuss some KPIs, but before I do that, I'm going to show some payable terms. So I thought about how to explain this slide. Don't pay attention to these percentages yet. So on the customer side, these are the payable terms, paid within 30 days, 30 to 60 days, or more than 60 days. So when it comes to customer, you want your money quickly, so you want your customers to belong here. But this is a random number I picked for you. Maybe 30% of your customers fall in this category. Then you want to bump them up. You want to work on bumping them up. Paid between 30 and 60 days, maybe there's some customers will fall in this category, but you want to sustain them, but gradually shift them to that box. And then on the customer side, paying after 60 days, if you can any way work your magic and reduce the number. Let's say 40% of your customers are in that group, you want to reduce them and shift them upwards. On the supplier side, it's just the opposite. You want to pay as late as possible. So you want payment after 60 days. So most suppliers should be here. Some suppliers should be between 30 and 60, and very few suppliers here. So depending on where your percentages fall, you want to shift these two boxes downwards and increase. This upward arrow means increase that box. So another thing I want to point out is this payable is always a liability in your balance sheet, right? So, okay, let's go to the next slide. And I'm going to talk about a concept that has no real meaning in your financials, but a lot of meaning in terms of as you operate your business. So receivable is what you get from your customer. So I showed it green. Payable is what you're paying your suppliers. The difference of these two is called working capital. So it's almost like you want to keep a healthy working capital. So if you delay the terms for suppliers and bring the terms forward with customers, this working capital will be healthy. Why do you need that? You can get into crisis like we had during COVID or other crises that's beyond your control. Then you can use your working capital to overcome some of those crises. Now I'm going to show you some spreadsheets that I call KPIs for supplier and customer. So this is a supplier log you can maintain. Let's say you have these suppliers. What is your relationship period? When does the contract renew? Because you need to know that. Maybe you want to go for a better pricing from him. Contract period. When did you visit them last? Remember the relationship side. And what is your quality assessment or a manager's quality assessment on what you're getting as in terms of supply? And this column here is very important. Do you have backup? If that supplier goes out of business, you must maintain backups for your critical parts unless you're holding a lot of inventory of supplies, which you don't want to because it shows up as a liability or a payable. So I noticed that there are no's here. The question as a business owner is, do I need backup supplier? So if you maintain this log, which is nothing mathematical, but you know that it'll help you make those decisions. We go to the next slide and show the same thing for customers, but I have added a few more things to that. Next slide, please. So this is the customer log. Remember, these are people that are paying you, that are adding to your revenue line. So let's say you have these 5 customers. Again, relationship period, contract renew date. When this comes up, you must assess if you have an opportunity to raise your price. Contract period. I'm going to skip this for now. When did you visit them last? What are your quality assessment? What are their quality assessment of you? Meaning that here you want to be 100% with them. You should strive for 100%. Now this is the thing that I emphasize: percentage of total spend. So let's say I'm one of your customer. I buy a product that you're making or a service you're providing. Let's say over the year I spend $50,000 on it, but the amount I give you you're supplying me is 10,000. So I'm giving you 20% of my business. Why is that? As a business owner, you need to understand, can I take more and more of his spend? Maybe you can do some touting with him that your quality is good, your price is low, whatever the case may be, but always be alert with that when you go to negotiate. You want more spend. You want, if possible, his total spend. Then I put in 3 things here. If you have customers that have gone dormant, you must understand why and how to bring them back. List of infrequent customers. Why are they infrequent? Are they buying from somebody else, buying from your competition? And list of your competitors' customer, how to win them over. So see, this kind of KPI, even though it's qualitative, helps you. Now I'm going to go into production planning and capacity and close this section out. So production planning, this slide shows the forecast from your customers. They're telling you whatever product this is or service, they want 10 of this, 20, 30, 40, 50, 60, 35, month by month. Same thing with product B, service B, product C, product D. Looking at that, I also want you to get a feel for your product categories. Like this is a summer product, like maybe you are in clothing business or you are into lawn care service. Then, excuse me, the forecast goes up in the summer months and then comes down, right? Our forecast may be non-existent in the first part of the year. So those are called summer products. You may have winter product business, be it snow removal, be it selling, summer clothing, things like that. And there, the forecast should be higher in the first few months, and then probably dip and then start growing again. So by looking at the forecast, you know what kind of product is that and how to position them in a way in your planning. I'm not talking about planning. When to make them, do you want to store them for summer sales or winter sales, things like that. Then there's a category for erratic or cyclical products. These are products that you don't understand the demand. They just vary all over the place. An example on the product side could be, let's say a sports team wins their tournament, then they want a lot of t-shirts. And again, I'm going back to the t-shirt because I showed you that process map. But if you, let's say you also have cyclical nature in the service side. Unfortunately, we see a lot of weather disasters these days. So if you're in the building business, or if you are a disastrous trash removal business or whatever it could be, those are for you cyclical, sorry, not cyclical, but erratic. They come and go. You cannot predict them. And there is a category called new product. This demand actually, if it's done right, if your customer is launching a new product, the demand should go up because he's going to sell more and more and more. So the idea here is know how to study your demand and then plan your operation accordingly. In terms of accruing, in terms of how many machines you may need, things like that. Sometimes you shift off your peak production to somebody else. You don't want to buy machines for your peak demand. I'll make the case for it in the next slide. These are concept I introduced here called lead times, and that's why I shaded these boxes. If this is a product that needs 3 months to produce or a service 3 months to prepare for, you don't want the numbers to change within those 3 months. And you can understand why, because you want to work with numbers that are fixed. So in your contract negotiation, you must let your customers know what is your lead time for the different products or services. So the next slide, there are a lot of questions coming up in the chat.
We down to 5 minutes, so you might want to take some questions. We won't have time to finish the presentation.
I have to introduce the other things very quickly.
Okay.
And then we can, because otherwise the discussion will not be complete. So we go to the next slide. Here I make the case that based on your demand, always design your capacity. Remember your people or your equipment for an average demand. During your peak demand, increase your shifts or work on weekends. If your demand slows down, that means your competition is gaining on you and you have to either your sales and marketing people will have to work harder. And by the way, we started 10 minutes late, so I'm running a little bit behind. So next slide. Next slide, please. So sales and marketing, we're not going to cover too much other than to say marketing raises awareness and sales creates your customers and gives you the revenue. And so there are some listing of how do you judge on your promotional spend, which we already talked about that. Your sales marketing people should be able to give you sales forecast for the next 2, 3, 4, 5 years, or you as a business owner should be able to get there so that you can plan your future years. Now I'm going to spend 3, 4 slides on strategic thinking. If you want me to stop here, these are the KPI slides. I can stop. What would be your desire? Okay, strategic thinking. Strategic thinking is nothing but for you as a business owner to assess where you are today. And you do that by doing all the measurements we talked about. And the end point is where you want to be if you can grow your business. So, and what you have to do to get there. So this is action plans. So where you are today, you understand from your measurements you take organization-wise, staffing-wise, finance, operation, market size, and market share, because that's where you have to have that understanding and stability of your business before you can leap forward, before you can jump and grow your business. So once you know that, where do you want to go? You want to set targets on your revenue target. Maybe you want to increase your market share. You want to introduce a new product or service. You want to sell in different regions. Maybe you're Illinois based, but maybe you can find a partner and do business in California. You want to introduce maybe a new business unit because your competitor has a business similar. He has everything that you have, but he has something more. Do you want to introduce those businesses? That's also strategic thinking. And then if you are that adventuresome, being a small business, if you want to go from US to ex-US, meaning outside the borders, which can be done. There are mail order businesses, there are virtual businesses that you can export to the outside. When you decide what you have to do to get there, this is where your goal setting, your RACI teamwork, your financial and people capacity, equipment capacity, all of those enter in this here. And you have to decide whether you want to increase some of those to jump into this space. Now, I've said this in a common way for your whole business, but you can do this for each part of your business. You may have 5 products, maybe one is ready for strategic growth, not all of them. Or you're into 5 different kinds of services, only one is ready for growth and the others aren't. Let's go to the next slide. I have only 3 more slides. So this is a SWOT slide. If you want to understand where you are today, you have to also do a SWOT analysis. I pulled this out of the internet, but you as a business owner need to list your strengths, your weaknesses, and mind you, these are your internal measures, what opportunities you may have, and do you want to take them? Are you at a position to take them? And what threats? What is your competition doing that could be a threat for you? So a couple of points I want to make. If you know your strengths, you want to leverage them in your messaging, in your website, so that you can gain new customers or you can retain your current customers. If you know your weaknesses, you must know them before your competition does, because otherwise they'll start taking your business away from you. And depending on your weaknesses, you should not plan on growing unless you rectify your businesses. Opportunity area, be cautious how to jump on opportunities. Do not bite too early. And never lose sight of threats. Remember, I said 50% of small businesses can fail in the first 5 years. So threats are important to keep an eye on. Next slide. So this is a philosophical slide. Now, after you have listened to my talk, you may be wanting to make changes in your organization. And some changes are big change, some changes are medium-sized change, and some are small. So small changes will not bother you as much, but big changes are like this. You are at a comfort level on your current state. When you make a change, the comfort level will go down. In the new state, to achieve comfort level, it will take time. So as a business owner, when you introduce to changes, if they're big or medium, you owe it to your employee to make this time short, meaning that time to get from this comfort level to that comfort level. And also this depth of reduced competence, because you're going through a change, your output will be less, your employee satisfaction will be lower. So you want to reduce this depth. So that is your job as a business owner when you implement changes. It is not easy to go through a change, as we all know, in all aspects of our lives. Next slide. Strategic financial choices. If you have extra cash, paying off debt versus expanding your business, how do you see it? Contract negotiation on the terms of receivable, payable is very important. Quick conversion of inventory to cash. I've emphasized that many times. Maintaining good reserves and working capital is always healthy. And then this was a webinar on KPI. You shouldn't let a good KPI go to waste. So I list some things, how to use your KPI when you measure things, like good customer service, high product quality, may be used to negotiate with your customers and attract new customers. Measurements like output per day, on-time delivery, good safety record may be used to boost employee motivation and morale. And then measurements like competitive product and service costs, customer feedback, you should use them on your social media messaging website to capitalize on what other people are saying about you, and assuming that they're all good. So I'm going to wrap this webinar up. by going to the next slide, where I will remind you that you must be aware of your business cycle. You must look at your organization in those 4 or 5 aspects. You must spend a lot of time on your people, do your process maps and use them. Learn to read your financials effectively and make good use out of them to understand your weaknesses and so on and so forth. Operation side, we all talked about capacity and other trends in the operation side that you have to keep an eye on. You have to have strategic thinking for your business, because if you don't, your competition will and they will outplay you in your market space. With that wisdom, I close the webinar and ready for questions. Somebody has to kind of prioritize and read out the questions.
Okay, we got time for like 3 questions. Is this percentage higher for small business owners of color? If so, by how much?
Yeah, can you repeat that, please? I was just distracted by something here.
Is this percentage higher for small business owners of color? If so, by how much?
Oh, I mean the success rate?
Yes.
Yeah, I don't have that. I think when SBA does that kind of a statistics, they don't look at whether the business owner is owned by minorities or people of color. Maybe they have it, but this was the overall statistics. And there is no implication that if it's a business, it's a minority-owned business or business owned by people of color, that they are weaker in any way than other businesses. I think I do not subscribe to that, because I think there are strong business owners in all segments. Next question.
Just to be clear, are there any specific points that we need to know that you would like to repeat?
Yeah, I summarized, you cannot know part of your pie. You have to know your whole pie. So you have to, what we said on the last slide in wrapping it up, you have to know your business cycles. You have to read your financials. They are very, very important. You have to do your process mapping and use them. You have to make sure that your operation side is the lowest cost or optimal, and your sales and revenue side is growing. If you know your business cycle, you know that where each of your products and services are, and you need to have different focus on each of these business segments. So I cannot really wrap it up in one or two special areas, but those are all important. So if you have a business, I would say that start paying attention to all these different sides. It will take a little time for you to learn that process, but don't give up. As you know, everything takes, they said that you make your habit makes you. So if you make your habit, after a while, it will come automatically. I compare it to doing yoga. I mean, when you first start doing yoga, you say, oh boy, this is too much. But when you practice it, after a while, it just comes automatic. So these KPIs should be in your habit. Any other question? I'm available as long as you want me to be. I have no time restriction. I left a lot of time for today.
Can you give your phone number again and email that you mentioned at the beginning of the presentation, please?
I never mentioned my phone number, but you can, whoever is asking this question can send an email to you and you can forward it to me. I think you have my email address, right? Or should I put it in the chat box?
Put it in the chat so everyone can get it.
Okay, here is, you can reach me at this, okay. So because I'm a presenter for SCORE and BACP today, that's my email. Now, if you send me an email and you want me to give more attention to your question that you may have, I will, then decide if we need to talk a little more regularly. I can become a mentor if that's what you desire. And then I can give you a lot of different ways to get in touch with me. But it start out with that SCORE volunteer email.
Well, we would like to thank you for today's presentation. I thought it was very informative. I hope our attendees got everything that they needed out of it. Thank you again to our attendees as well and to SCORE. If you are a part of the BACP Entrepreneur Certificate Program, you get credit for joining this webinar by sending an email to bacpoutreach@cityofchicago.org. Again, that's bacpoutreach@cityofchicago.org. To learn more about our upcoming webinars, please visit chicago.gov/business education. Again, that website is chicago.gov/business education. Thank you again and have a great evening.
And I thank you for all the nice comments I see in the chat box. I hope, if you need to, you can reach out to me. Start with that email, and because my joy comes in if I can help you stabilize and help your business grow. So, thank you, and I will sign off.